This is Mathur, and welcome to everybody to this second webinar in our risk management and compliance series. So we're talking about future-proofing your risk management and compliance with craft technology. And I have Harlan Duman with me, who's part of our solutions team at Neo4j, and will also be doing a demo during the session today, and he'll be helping me with that. So without further ado, here's the agenda for today. We're going to talk about sort of the regulatory maelstrom that is hitting financial services organizations today. And then we'll kind of just walk back a little bit. Sorry, just I think my screen was not yet showing, so just make that happen here. Hopefully you can see that now. So from agenda perspective, we'll then talk a little bit about BCBS 239 and credit risk management, which we covered in our last webinar. And then we'll focus right in on FRTB compliance, which is a fundamental review of the trading book, which is a new Basel requirement for compliance that is coming online, and how that impacts risk management for banks and hedge funds and the like. And we could move forward from that and talk about the need for a modern risk management platform, given all these changes that are happening with financial services and regulations and risk management. And then we will go into a demo, and we'll show that and show some aspects of data lineage, what is required from a compliance perspective, show some aspects of risk calculation in real time and risk aggregation in real time, and I think you'll like that. And then we'll kind of close out by talking about how graphs uniquely address these requirements for risk and compliance, and what the industry speak is on this topic, and kind of a summary to close it out. So with that, go into today's financial services regulations, which are actually pretty dizzying. So if you look at this, these are all the, or not all actually, majority of the regulations that are, that financial service firms need to comply with today. And so it's a pretty involved set of regulations, and most financial services firms actually have separate teams attacking each and every regulation, although sort of the data behind this, these regulations, a lot of it is similar, a lot of it is in common. So there's a lot of spend that financial services institutions are having on, first of all, understanding these regulations, bringing consultants in that can help them with that, and then implementing some sort of a solution and reporting around all of these regulations. And the biggest challenge is bringing the data together from all the different silos to be able to report on these regulations. And if you can imagine, multiple teams doing that every quarter, it's quite an undertaking and a huge financial burden for financial services firms. So can they do better? Yes, they can do better, and we'll talk a little bit about that. But this is a pretty big deal for most of you out there, probably on this call. So with that said, I think we covered some aspects of that in our last call, which was about 2 months ago. There is a recording of that webinar as well available on demand, and I'll point you out to where you can get that. But we talked about BCBS 239 and its regulatory principles. And if you look at this picture here, you can see that a lot of these around accuracy and integrity, timeliness, accuracy in risk reporting and distribution of reporting, supervisory reviews, etc., are very, very focused on data and having the data lineage that is required to get to the authentic and authoritative source of the data, and maintaining that lineage over time, so that accuracy, that integrity of the data cannot be lost. So you cannot have a missed transaction, you cannot have a broken piece of the lineage while 99% 90% of it is accurate, even the 10% that's missing will have a big impact on your regulatory requirements and fulfilling that. So what you need is something that can maintain transactions and accuracy and the lineage all at the same time. And that's where Neo4j as a graph database falls under the governance and infrastructure bucket of BCBS principles, maintaining that data governance and data architecture, if you will, for these regulations. And as part of that, we showed a credit risk management demonstration, having an application that analysts use to really see the connected nature of companies. Most financial service institutions have a lot of data on companies. They also, from the internal silos, they also bring in a lot of market data. And if you connect all of these silos together using a graph database, you get metadata layer that then can bridge these silos together. And now you can sort of track how market events and news cascades through these connections that companies have with one another through either contractual connections, supplier relationships, ownership relationships, and things like that. And we showed how a bank that is loaning money to companies that are ostensibly not related to the market event, how they get impacted over time through these cascading sort of relationships. And you can only kind of visualize that and have that understanding of that impact analysis through a graph or through this connected set of data that we presented in this webinar. So take a look at that as well. Wanted to kind of just make sure that there are multiple aspects of these regulations, and we covered BCBS 239 credit risk management earlier. And if you go to that link below, neo4j.com use cases, and click on privacy risk compliance, you will get a recording of this webinar. So for today, then we'll focus on a fundamental review of the trading book, which is actually a regulation that is part of Basel set of accords. It was originally part of Basel III and due to be implemented early next year. But because most banks are not ready for it, because of the challenges with data and integrating all of that, this has been pushed back to 2022. But banks need all of this time to be ready for this, and I think we have a particular point of view on how they should go about this. But essentially what it means is that banks have trading books and banking books, and trading books are used for assets that are traded on a regular basis. So things like stocks, bonds, mutual funds that banks trade on a regular basis, day in, day out, that their traders are managing. That is, all of those assets go into the trading book. Banking book is more for assets that are long-term in nature, that are held to maturity, and doesn't need to be valued daily. And those are some examples of that might be, for example, a corporate loan, which usually is held until maturity and not traded and things like that. So essentially, banking books have low reserve requirements because it's a long-term asset, and trading books have high reserve requirements because these are very frequently highly volatile, highly risky assets that are trading very frequently. And so the reserve requirements have a direct bearing on the P&L of the bank and the potential profitability of the bank, because obviously the more capital that you put to work, the higher potential return. So having high reserve requirements, impinges on that ability of the bank to really generate higher profits. So the whole idea is that there is a risk model that is prescribed, and so banks can either accept the capital reserve requirements for their set of assets from the federal government and the Fed, essentially, or they can actually apply to use their own model. In order to apply to use your own risk model, which is beneficial for the banks because they lowered the capital reserve ratio based on the specific model that they have computed based on historical back testing back 10 years. So they've built a model using actual asset prices back 10 years. And back in the day, it used to be that this was enough to go forward with. And once the back testing was complete, this model was submitted to the authorities and it got approved. They could essentially move on with this model for the future. But what it didn't take into account was that the markets are changing continuously, and you need to continuously backtest to make sure the model is still up to date, because suddenly risk creeps up into the model, and the model is no more, conforming to sort of the green zone, if you will. So what banks now need to do is continuously monitor prices that are part of this model, and continuously test. So after they submit the model, it gets approved, you need to maintain a 1 year worth of price data, 24 specific price points, 2 price points per month. That's all in the details. But essentially what this points to is that you need to maintain a lineage from your trading desk all the way to prices constantly. And this is very dynamic in nature because prices are changing every day. New price points that need to be adhered to as part of this continuous testing model keep changing. As you trade, your assets and your positions and your risk levels keep changing. So you need to continuously compute this on a daily basis. And that's what banks need to do in order to maintain that risk model and use a lower capital ratio, which leads to higher profits in theory. So that's kind of the idea. And so if you look at a large bank or a hedge fund, their trading desks could be organized in such a manner. So you would have multiple trading desks, like an energy desk or a technology desk or a commodities desk and so on. And then within trading desks, there are multiple baskets of trading instruments. In this case, we're mostly talking about stocks, but it could be any tradable instrument. And so these baskets could be shared among trading desks. So think of a basket as a mutual fund, in effect, that is not priceable directly. And then there could be a series of baskets that are within another basket. And then eventually there are tradable instruments like equities and so on, indexes and options and so forth that are directly priceable. So that's kind of how the entire spectrum is managed. And so you have essentially a lineage from a trading desk to a basket to another basket, and so on, until you actually reach a priceable entity or instrument like equity or option and so forth. And this entire lineage, which is pretty complex, needs to be maintained. And as I was mentioning, this is not a static lineage. Prices keep changing. Based on trading behavior, the basket will keep changing. The desk, the instruments associated with the desk will keep changing. And we need to maintain that lineage throughout this process. So it's a pretty complex and dynamic activity. And as you can see, this is really a graph, because some baskets could be shared across different trading desks and so on. And obviously equities can absolutely be shared between baskets and trading desks as well. So we need to constantly evaluate the interrelatedness of these investments, and graph technology is the right solution for this type of a problem. So this chart really is showing the price points. So as I mentioned, we have to track per year 24 specific price points that map to the risk formula that you have submitted. And as part of that, there is a risk gauge, if you will, that is part of the risk formula, and as per the requirements, the variation or the fluctuation of the risk score needs to stay in the green zone for constantly for this formula to apply. And if the risk constantly moves into the red and amber zone, then the regulators will come back and request the bank to reformulate the risk and backtest and resubmit and so on. So that monitoring aspect is very critical, and continuously monitoring the risk levels of not only in the desks, but the trading, but also the baskets and the individual stocks and bonds and other instruments that are being traded. So as you can kind of probably gather, that tracing this lineage back all the way from trading desk to individual prices, and then aggregating the risk back up from actual individual priceable entities back through to the trading desk is sort of the two sides of the same coin. And it's really that lineage and that graph that is instrumental in making sure that both of these things happen at the same time. And what is critical is being able to compute this in real time. And that's where a native graph database technology like Neo4j really shines. As we are not looking at indexes every time we go to a next part of this lineage, next part of this chain of data elements from trading desk to prices. We're computing that based on CPU math, which is known as index-free adjacency. So we are directly going based on the relationship to the next element in the chain. And that's what makes this extremely speedy. And you'll see that in the demo, how quickly things get computed in real time. And so these internal risk models, as you can see, underlying this, the data comes from a lot of different silos, like obviously trading desk, baskets, and fund management systems, trade and position data systems, your core banking systems. In cases where you're tracing loans, like we showed in the last webinar, the loan data and loan management systems, and of course historical and market prices and market data as well. So this is a pretty involved data set that needs to be stitched together with the metadata, and graphs are the right way to kind of think about this. What you're looking at here is really a graph, and this is the relational technologies are very inefficient at computing these type of things in real time, because it involves several joins across several internal tables in one silo, but then also jumping across silos. So it's really an inefficient way to think about solutions, which most financial services enterprises are based on relational databases today. And that is why they cannot able to scale up to this type of risk management solutions. So I think we've sort of established a little bit of a case for a modern risk management platform based on the needs of graph technology. And so here, what we have put together is sort of a graph platform based on Neo4j, and that does both data lineage and risk management. That has, you'll see in the demo, some calculations around risk that can be done in real time. It has a compliance manager that can basically support adhering to the regulatory compliance needs and creating these reports right off of the operational model. So it's not a separate model that you have for compliance that gets out of sync with your original risk model. And so making sure that the compliance and creating these reports of a particular time are accurate and valid and consistent with the actual data that you have. And then obviously providing with this set of connected data, a lot of analytics on top of that for not only your trading desk and traders, but also management and how they look at that. And we'll show some of that in the demo here. But essentially from a benefit standpoint, you're spanning data silos. We talked about lineage and aggregating risk, but obviously being able to have that auditable precision and using the real-time data for reports and then having that data consistency and resolving time-related data consistency issues so that you can create reports as of a particular time across all these silos, even though data comes into these silos at different points of time. But being able to track where the data originated from helps us understand, these as of a particular time reports, which are a problem in the industry. And also because of the nature of graph database, which is a schema optional system, the platform is very adaptable and future-proof as new elements to the schema, new silos, new data sources can be added over a period of time. So you don't have to build everything all together. You can incrementally build your system. So we'll move on to the demo, and I have Harlan here helping me. So Harlan, go ahead and introduce yourself, and let's get into the demo.
I'm Harlan. I'm an engineer on the solutions team, as we talked about a little bit earlier. And I'll be demonstrating how you can actually use these ideas in practice on a data set, and we'll be showing some of the things you can do with Neo4j.
Blake, could you transfer presentation to Harlan?
All right. So for this presentation, we're going to be using Bloom, which is a product from Neo4j, which is meant to allow you to explore your data visually. And it can be used by both technical and non-technical people. So to start off, let's kind of explore this data model that we're using. And we can start at the highest level by just typing in trading desk and looking at what our trading desk nodes look like. So you'll see in this data model, and in this data set, we have 3 trading desks that we're looking at: the energy desk, and the transportation desk. And what we can do with Bloom is actually expand these nodes, which means we can see all the other nodes that they're connected to. So let's look at the energy desk, right-click on it and expand that. And we can see it has connections to some other types of nodes. So these purple nodes here are basket nodes, and these are, for example, an energy index, a clean energy basket, a batteries basket, and these green nodes are individual equities. And so this energy desk has positions in individual equities, and it also has positions in baskets. And these baskets, if we expand one of these baskets, for example, the energy index, we can see that those baskets trade nodes also. So those baskets have positions in other equities. And so in this data set, we're very much focusing on just one type of asset, just for the sake of simplicity and demonstration. But in real life usage, you can expand on this to have any types of nodes that are relevant for your specific use case. And that's one of the benefits of using Neo4j, is that you don't need to define your schema all at once and set that in stone. You can kind of update it incrementally based on your specific needs and have nodes for any type of asset or investment class or any type of basket that you have.
Yeah, so I think what you're seeing here is kind of a actual implementation of that whole model I showed earlier on the slides, from trading desk to baskets to individual stocks or other tradable instruments. and then you also have prices, right, Harlan, as part of this.
Right. So one of the things you can do with Bloom as well is not just explore the connections in the data, but explore the actual data itself. So we can double click on a node and see which data we can look at for it. So we can see the last risk score here. We can see the risk score we have currently, the name of the company, the price of a share in this company, the symbol, for example. And this obviously can be adapted to whatever need the use case needs. And so I think now we can talk a little bit about how we're actually calculating this risk score and how we can aggregate that up based on these relationships to baskets and trading desks.
Yeah, so in terms of the risk score, we've kind of just have a simple formula to calculate it, but in reality, each institution, each financial services organization is different, and the way they calculate risk is highly proprietary in nature, as most of you know. So we're not attempting to be a financial services institution by any stretch of the imagination, but we're just trying to demonstrate that this is how you would sort of implement a solution like this. The risk score that we have used here is based on RSI, which is a relative strength indicator, and also the ROC, which is the oscillation of the actual prices over a period of time, right? So you've sort of averaged the two, and then that's how we've come up with our risk scores. And theoretically, it's between a 0 and 100. So this is basically like a percentage. So with the energy index, you see 1.58. That's basically 15%, 15.8%. Right. So I think in addition to that, do we want to show the price points as well, so that we can show the entire lineage here, Harlan?
Sure. So another aspect of this data model is that each equity actually also connects to other types of nodes. And so if we expand, for example, this equity here, we can see we have 24 price nodes that are attached to that equity. And these price nodes represent the 24 price points in the last year, 2 price points for each month. And so each of these price points have a date and a price attached to them. And we can use these price points in our risk calculations. And another benefit of this graph database is that you can aggregate your risk on these baskets and these trading desks based on the relationships to the equities. And so the way that we aggregate the risk on the baskets and the trading desks is we calculate out our total positions to each of these equities, and based on how much of a position we have relative to the equities and the risk score that those equities have, we can create an aggregate risk score for this very, very quickly compared to how you would be able to do so with other database solutions. So let's explore that data lineage concept a little bit more in depth. So I'm going to clear the scene, and I can type up here actually lineage of, and I can type any name for an equity. So let's try to see for NVIDIA. What would the data lineage of NVIDIA look like?
Yeah, so this is really cool. I mean, Bloom helps you really, use natural language for searches, and it's very, very powerful for analysts, and management alike to really use natural language to get all of these analytics and also leverage this data set in many different ways that was not originally intended. And that's really the power of Bloom.
Right, and so we can define any of these natural language search terms that we want. And as we go through the demo, we'll see that we have a few of them defined here, but you can define these yourselves in your own use cases to be used by any sort of analyst, whether they're technical or not.
So here what we see is that NVIDIA is actually being traded by the technology desk and the transportation desk through these two different baskets. So you have a view of how this security is being traded across the enterprise, which are the different trading desks, and then you have a complete lineage front to back on NVIDIA, right from the technology desk to the 24 price points that you're required to maintain over over a year to continuously test the risk formula associated with the particular desk. And we have also the risk scores of each. So if you look at NVIDIA and look at the panel here, you have the risk scores calculated out as well. And all of this can be done dynamically, and I think Harlan's going to show that here shortly by sucking in a new data feed from the market. But there's also, so this is a view of lineage from a particular instrument or a particular stock perspective. We can also show the lineage from a trading desk perspective.
So I'm going to clear the scene, and then I can also, I've defined this search phrase to work for both individual equities and trading desks. So for example, if I want to see the lineage of the transportation desk, it auto-completes for me, and I can see the entire lineage of a trading desk visually. And so we can see that there's multiple baskets that are being traded, multiple equities that are being traded. Some equities are being traded multiple times in this trading desk in different ways. And on each of these equities, we can also expand out to see their specific data lineage as well. So if we want to see the price points, the 24 price points for different equities, we can also expand out those specific nodes and really get a holistic view of the data lineage. So like we talked about, I'm going to simulate a data import on another screen. In a real world system, this would be happening automatically, and there would be systems set up to do this. So what I've done here is I've updated all this data, taken in new prices, recalculated risk scores for both the equities and recalculated the aggregated risk scores for the baskets and the trading desks, all in about half a second on a MacBook Air. And what's nice about the native graph solution is that it also scales very well as your data set grows and grows and becomes more complex.
So what you're not able to see is that Harlan's using his second screen to basically ingest this data. He's actually doing it within the Neo4j database, and he's just got a simple query that uses a procedure to ingest data from a CSV file. This could also be a direct feed from actual market data sources, which we are using in the background to get this data, and we could easily just basically have a streaming approach to ingesting that data through a Kafka stream or something like that. So it's very much real time. We're just simulating this here for our demo purposes.
And so one of the things that happened with this data import, as well as all this, in addition to all this risk recalculation, is that we can also generate alerts based on this new data that's come in. So I can search for alerts in this database. And it looks like for this particular data set, there weren't actually alerts generated because the triggers were not triggered for how much the risk score has changed. But you can imagine that in a real world situation where you're taking in prices and recalculating risk scores on a continuous basis, you can continually generate alerts and continually alert your analysts as to which equities they need to explore specifically and which lineages they need to trace. So one more thing about the graph platform that can be really unique, one way you can leverage this connectedness in how you represent your data is finding the connections between different nodes. So for example, you might have an equity that's traded across multiple trading desks. And that might be an important thing to see from a risk management perspective. And so if you wanted to specifically, and we saw a little bit of that earlier when we looked at the lineage of NVIDIA, but if you wanted to find other equities that also are traded across multiple baskets, you can define a natural language search query to do so. And so we've defined one here where we can just say connections between trading desks. And we can get a visual view of all the equities that are traded by multiple trading desks and how exactly they're traded. And so some of these equities you can see are very, very highly connected. For example, Tesla here has lots of relationships coming into it and has is being traded in lots of different ways. And from a risk management perspective, it's important to understand when you may have more exposure to a certain asset than you realize because of all the different ways that it's being traded. And so we can trace back, for example, a company like Cisco is being traded through this electric and autonomous cars basket, which is being traded by this transportation desk. It's also being traded by this cloud computing basket, which is being traded by the internet basket, which is being traded by the technology desk. And so this is one way you can leverage this sort of connectedness in your data to extract value from a risk management perspective. And another type of connectedness that might be important is finding connectedness within one trading desk. So many of these equities are traded across different trading desks, but are also traded differently within the same trading desk. And so that one may have more exposure to that specific equity. So we've also defined a search phrase to find that. So we can look up in plain English, connected equities in any of these trading desks. So for this one, let's look at the technology desk. And we can find there's lots of equities in the technology desk that are being traded in many different ways, in many different baskets. And it's important to get this overall holistic view of how you have exposure to lots of these different assets. And so if we trace something like Microsoft, it's being traded in many different ways. It's being traded through this artificial intelligence basket. It's being traded through the cloud computing basket. And I think this provides value in a lot of ways, including allowing you to reevaluate sort of how your baskets are composed and how your trading desks are composed. And you can see if there's a lot of crossover between multiple baskets, you may want to take action against that and reorganize the way that trades are happening.
Yeah, I mean, for instance, if you have, 80% of the stocks are common across two baskets, that would be a case to maybe combine the basket or make the objective of these baskets significantly different, where that doesn't happen. So these are all things that management can do to analyze this data, or traders or heads of each trading desk can look at this data themselves to analyze their trading desk and how it's doing, and what are the areas of risk, what are the hot spots within their desk, how are each basket sort of being managed within their desk, and so forth. So a lot of great analytics, which is essentially a byproduct of managing risks more effectively and adhering to the compliance regulations by using this connected data approach.
So I'll just show you a couple more natural language search phrases that we've defined here. So if you're an analyst, you can easily go and see, let's say I want to see the top 3 highest risk baskets. And you can go and see it's these 3 baskets: cloud computing basket, the internet index, and this internet basket. And you may want to do this in multiple different ways. So if you want to see the riskiest stocks or the riskiest of a certain asset class, for example, we can find the top 10 riskiest equities. And then we can, when we have all this data at our disposal right here visually, we can explore through and see how is it connected to each other, how is it connected to other data, and really explore our data visually and draw insights in ways that we may not expect otherwise. And so for this demonstration, we have used Bloom for the entire thing, just to show how this product can allow you to explore your data and gain insights from it. But in real world systems, it can be a combination. We can use Bloom, we can hook this up to other systems, and you can hook up these sorts of queries like finding the riskiest baskets, the riskiest equities into other systems, and then process them through that.
Yeah, and that's a great point, Harlan. I think, in a real life situation, most large banks and hedge funds, have their own applications for risk management. So, this could be basically an add-on to the existing application to view this data in a graphical manner, and then provide Bloom as an additional component that can then do some ad hoc analysis and more natural language-based searches into that data as well. So it's a combination of an application that provides a fixed amount of output, and then also this more free-form and free-form analysis with Bloom, and that combination is going to be really powerful.
And so another thing we can do with this real-time risk aggregation, risk calculation is trade simulation, and we can sort of quickly understand what would our risk look like if we trade in different ways.
Yeah, so for instance, as you are about to undertake a trade within a desk or a basket, you could basically simulate that trade here. What you didn't see very well here was that when Harlan imported all of this data with the new set of data from the data feed, he actually recalculated the entire risk score across this entire graph, right? And that happened in milliseconds essentially. And we didn't show you the before and after picture very clearly, but the whole risk calculation based on a new set of prices and new set of RSI and ROC was done dynamically here. And so when you are simulating a trade, essentially you can then look at how that has changed your risk perception within the desk or a particular basket where you're doing that trade in, and how's that risk with this new set of positions changed the dynamic or the outlook, and is that sort of moving, is that helping you stay in that green zone, or is that something that is moving you into the amber zone or whatever? So you can actually have alerts built into that simulation process, and it can actually output exactly where this is having an impact. So you can do that entire impact analysis based on the simulation with this in real time. Did you also want to show sort of the highest price points? And okay, so I think this is a good view into sort of using Bloom and how you can sort of essentially analyze this data and get a view into some of the analytics that help power your business, make decision making for both the trader, the trading desk head, managers in the organization, and so forth. So hopefully that gives you some insight into how to integrate Bloom and an application around risk management together to solve your problems around both compliance and risk management. I think that's kind of concludes our demo, and we can move into a couple of slides here to close this out, and then we'll have some time left over for questions. So I think that's great. So Blake, if you could give me presentation rights again.
Yep, you're good.
Great. And hopefully you guys can see my screen now. So again, how does graph technology uniquely address these regulations and risk management? So clearly, we looked at data lineage, we looked at real-time risk aggregation, we talked a little bit about temporal consistency, which is essentially being able to generate a report as of a particular time. It's actually a very hard problem because of how the data keeps moving around, and most databases record the date and time at which the data moved into that database, as opposed to when it actually changed the original system. And because of the way we maintain that lineage, we're able to actually understand when actual data change happened in the original system, and we're able to generate these reports with the temporal consistency needed. You saw some of the risk analytics that we showed here for the trading desk head, for traders, for management, and obviously the model visualization and being able to visualize that connectedness across all of these entities and nodes, if you will. and the compliance reporting along with that, and of course maintaining that governance across the board. So now this is something that is applicable across multiple different regulations. We talked about BCBS 239, FRTB, but also the capital adequacy ratio, the CCAR, MIFID and CAT NMS, which are more in the data transparency area, GDPR, which is more of privacy regulations, more prevalent in Europe for European. Obviously, anyone who has European data needs to comply with that, and that is also similar, where connected data is a critical part of the problem. Understanding where the data has proliferated, and understanding that. And obviously, anti-money laundering is also another great use case for graph technology. So across the board, you can see how graphs can benefit multiple financial services regulations. And it's not just us, but if you even look at industry speak, McKinsey, EY, and others, they're all sort of similar. So the Basel did a study recently and found that a large majority of the banks, 70%, cannot adequately explain their P&L and its drivers, and it's really coming down to how risk and is perceived over the entire bank, how it needs to be aggregated, how it's proliferated across the different silos of a bank, and being able to really tie that in back to the P&L, right? Banks, McKinsey essentially in their FRTB Reloaded paper is talking about banks focusing on implementing FRTB in a smart way, including that broader strategic goal of upgrading the infrastructure around risk management, not only in the front office but also in the back office, and integrating that across the board, so that you don't have different systems for compliance, different systems for risk management, and different systems in each different region, and then having some other way to integrate all of this data together. It's one system that works, and so you get accurate reports and the consistency that is required to maintain that risk posture and that approved risk metric from the authorities. And so here's a really great opportunity with FRTB to get sort of the house in order, but it's not just for FRTB. Thinking about it from an overall infrastructure point of view, and and having that technical architecture and aligned to this, to ensure that the data and the different silos of data are actually integrated together, to have to basically eliminate different sort of discrepancy among risk and finance views and business and so forth, and being able to produce those high quality measurements that is required by these compliance regulations consistently in an accurate fashion, right? And with the efficiency, so you don't have all this money being thrown into compliance projects, separately, but you have an integrated platform where you can provide all of these compliance reporting and integrated view of risk from. And so McKinsey also mentions that a select few of these leaders are developing proofs of concepts for applications of advanced analytics and artificial intelligence, and this provides a way to capture higher share of the efficiency gains in a shorter time frame and sometimes at a lower cost. So there is a lot of literature out there that these FRTB specifically and other regulations will take 3 points off sort of your bank's P&L because of all the higher capital reserve ratios that are required and so forth. But with using this approach, they also mention that if you have an integrated back to front technology infrastructure to support this, you can regain all of that 3% and more in terms of the better transparency, the enhanced risk management, and greater operational excellence. So I think it's not just us saying that, but that's kind of the broader leaders in the industry making sort of the same statements here. So we would really invite a lot of these proofs of concepts to build a next generation modern risk management and compliance platform using graph technology with Neo4j to manage this highly interrelated and connected data, and ensuring that the lineage and risk is looked at as two facets of the same coin and done in real time, and then also being able to visualize those models and gain a lot of additional value by providing those analytics for different roles within the organization. So there's a lot more on our website. If you go to neo4j.com use cases, privacy, risk, and compliance, you'll get a few white papers and webinars and related content there as well. So stay engaged, and happy to answer any questions you may have.